Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Thursday morning, markets, of course, settling down a little bit and looking a little better for the portfolios out there. Broader markets recovered. I'm Prashant. With me, my colleagues Nigel and Survey. Guys, hi, good morning.
Hi, morning, folks.
Morning.
So they say this too shall pass, and I wonder if it has finally passed, which is this whole brutal sell-off and correction.
Yeah.
Because yesterday was the first hint of buyers going back into the market, in the broader market.
Well, indeed. And today, if you're short on action, you have the weekly expiry as well that will play out. So that will add to the fizz. Let's see how it goes. But we're going to start off lower. Let's see whether or not that dip gets bought into.
Absolutely. And, we'll just sort of take it from the top as we always do, just run you through a couple of things. It was actually largely flat, so there's not very much new to learn from what global market action we saw last night. So both S&P and NASDAQ, by the way, ended at new all-time highs. The S&P was up about 0.25%. But as I said, I mean, this is just chugging along, nothing dramatic. Actually, most sectors were higher and some stocks did well, but nothing extraordinary or new signals in that sense for the market outside of the US. The 10-year was down 2 basis points, 4.53. Dollar index about 0.13 higher, still about 107 actually past 107. We crossed 107 yesterday. Oil prices about a third higher, $76 a barrel. There were the Fed minutes, of course, which came out. They've reinforced the cautious stance, signaling that they're in no hurry to cut rates. And of course, the other bit which we've spoken about for the last 10 days now is Russia-Ukraine. The headlines remain top of mind and they continue. By the way, Trump posted on Truth Social, and we'll put that entire thing out in just a bit. He took a hard line with Ukraine. He's taken a hard line, but this was black and white and out there. And took a hard line with not just Ukraine, but what I mean is the Ukrainian government, Zelensky-led government. They're, of course, calling for elections. They're saying he's a dictator. And under Zelensky, there's little chance of peace. He wants the gravy train running, etc., etc. So it kind of now seems like, it's like a face-off. There's US and Russia incredibly on one side, and then there is Ukraine and Europe on the other side. We'll see how this one goes. But European bond markets took note. So you had the German, Spanish, French, Italian 10-year yields, which shot up meaningfully, 6.5 to 9.5 basis points. The bonds weakened. That's it. I think this is going to be the big next global news flow. Some sort of a ceasefire, if it were to come through. We're expecting something to come. Let's see if it's going to be now or we'll have to wait longer. Now, just to circle back in time, the levels. Yesterday, of course, there was a bit of a recovery, but we failed to hold. So the 40-hourly exponential average is where the market found resistance. We crossed it intraday, and then we kind of sort of sold off and ended absolutely flat. Actually, almost unchanged from the day before yesterday's close. Now, you could look at the 40-hourly or you could look at yesterday's high, which is above the 40-hourly, and that's the resistance. 23,050 is the high that we saw yesterday, and that becomes the immediate sort of resistance. Support, of course, remains at 22,725. It's about 200 points away from where we left off yesterday. Bank Nifty is meaningfully outperforming the Nifty, and I think there's actually for both the Nifty and the Nifty Bank, but the Nifty Bank may be faster. Both seem to be in a bit of a bottoming out process. Is there one leg left down to that 22,725 levels, and then the market starts to base out and build on? We don't know. Tough to say. Impossible to say. But just generally, price action does suggest that this is a little bit of bottoming out action that we're seeing. So the Nifty Bank, by the way, closed above the 20-day moving average yesterday, and the resistance now is at 49,800. That's the 40-day exponential moving average. The 20-day we crossed yesterday, and now it comes to the 40 exponential. That's a daily average. And on the way down, yesterday's low, which stands at 48,804, becomes a bit of a level which one should be able to defend. So let's see if that comes into picture. GIFT Nifty will indicate how the start is likely to be, and we're indicating about an 80-odd point lower start this morning. Should be.
Absolutely. I mean, the Asian region is actually pretty red. Deep cuts across many of the Asian markets. And it seems that a lot of these tariff worries are now finally hitting home. Not that there was anything new or unknown that Mr. Trump said overnight, but it seems that his reiteration that there will be 25% tariff on auto, on semiconductors and pharma, a lot of this is finally kind of working through the system. And many of the markets, like in China, they've anyway had a good rally. So this perhaps becomes a bit of an excuse for booking profits. But it's not just that. There's a couple of fresh developments out of Asia worth noting. First is the PBOC's monthly moves on their 1-year and 5-year loan prime rate. Now, they've not cut the rate. They've left it at 3.1% for the 1-year LPR and 3.6% for the 5-year LPR, saying we're watching things carefully. And anyway, the PBOC governor was speaking earlier in the week where he said that the yuan needs to be stable, and the yuan actually has not depreciated as a lot of the other currencies, given all the tariff issues that surround the world and the overall strength in the US dollar. What, however, is also interesting to note is what's happening with Japanese bonds and the Japanese currency. The dollar index is stable at around 107, but the yen's strength is something really worth noting this morning. Look at that. I mean, it's almost 0.6% higher versus the dollar. This is when the dollar hasn't declined too much. So why is the yen strengthening so much? And by the way, start of the year, $1 was fetching you just about 152, 151 yen. It was fetching you 156, 157 yen. And now it's fetching you just about 151 yen, just below that handle of 151. So what has changed? Number one, there was some commentary from a BOJ member, and this member, Takata, said that the Bank of Japan should actually hike interest rates. Why? Because number one, there is inflation. We know that inflation has been accelerating in Japan. And number two, that there should be not too much of unnecessary risk that markets start taking. So therefore, rate hike is warranted. The 10-year Japanese bond is at a 15-year high. The level is only 1.43%, but it's a lot for Japan, and that's why 15-year high. So it's interesting moves in both the Japanese bonds and currencies, and now we are seeing yields as well as the yen move higher. For us, of course, the Nifty has been trying to stabilize in this zone of 22,800 to 22,900. Have we made the bottom or not? I think the next couple of days will sort of give us the final clue on that. But the good news is that the buyers returned to the mid-cap market yesterday, and the PSU space got a fair share of buying. But it was not just PSUs. It was a lot of consumer stocks, Swiggy, etc. Many other names were looking good. Can we see more of that? And that will build a lot of confidence. The fund flow picture is not building confidence because, again, yesterday we were discussing, X of Bharti, what happened or didn't happen. We're back to the same situation. 1,900 crores of selling from FIIs and about 1,900 crores of buying from DIIs. So more or less net neutral, marginally positive. A couple of important points on the macro front. The RBI bulletin came out for the month of February. What is the Reserve Bank saying? It's saying that high-frequency indicators are suggesting that there will be a sequential pickup in economic momentum in the second half, something that the market is also penciling in. And the RBI is saying the domestic momentum is likely to sustain going forward. The strong output in the agri sector should give a further boost to the rural economy, and it's saying that urban recovery is likely as well because inflation is coming down and there's a budget boost that's come through. So the RBI is sounding a little optimistic. Speaking of the RBI, just watch out. We'll have a whole new set of data points to track going forward, which is good, which will include actually labor market data here in India as well. So MOSPI has said that the periodic labor force survey data will be released every month starting May. This will be, the April data is going to be released on the 15th of May. That's the first time we'll get that labor data. And we'll also start getting the private capex survey release on the 30th of April. So new set of data points to map what's happening in the economy, which is good. And there's a change for IIP as well. IIP used to come with a 2-month lag. Now it'll come 1 month with a 1-month lag. So the first such new data is going to be on the 28th. So the 28th of every month is when we will get the IIP data for the preceding month, and the first set comes in April. So good news, more data points, more frequent data points help us map the economy. Just two stocks which are coming to the F&O party, so just leaving that on the table as well, Irida and Tata Tech. Let's see if there's some action on these two building up. But yeah, Nigel, I guess the bulls will hope that they can push through some more of what we saw yesterday.
Well, that's right. And just going by the screen that you just showed us with regard to the Asian markets, I think the Indian markets have underperformed. And today is a good day for the Indian markets to outperform.
Yeah.
That's the hope. And I would like to see that by the end of today. And that will give you some kind of confidence as well. Let's get straight to a couple of cues then. What did the FIs do yesterday? Not too much in the F&O market. They continue to remain net short with around 84% of their positions on the short side. Yesterday, they added some mild long positions. Moving to their positioning now, the client as well as the FI positioning, not changed too much out there as well. The FI is a net short. The clients are net long. And remember, this is, the highest we have seen in value terms as well. Now, yesterday on the index futures, you'll say there wasn't much change. But what was encouraging was on the stock futures. Clients added long positions, FIs added long positions as well. That's telling you stock-specific action will continue. And we know that overall, clients as well as FIs on the index futures, they're on opposite ends. But on stock futures, they're on the same end. Both of them are net long out there. And yesterday, in fact, it was good to see some buying on stock futures as well. The key point today is going to be, given that we're going to start off a little bit softer, is going to be the Nifty Bank. Yesterday, it had a good trading session. It ended towards the higher end of the band. And there was a bit of a short covering bounce that we saw. Not just that, if you're looking at the FI data and you further look at it, we look at index futures and then we look at what they did on the Nifty Bank. They bought close to around 300 crores in index futures. So, that's another encouraging sign. That's on the Nifty Bank futures. And we managed to end above the 20 DMA. So today, the key index to watch is going to be the Nifty Bank. Can it continue its outperformance? Will that dip get bought into? Very, very important, because there's a lot of uncertainty with regard to autos, pharma, tech. But this one, it's a domestic-facing theme. So we'll have to keep an eye out on the Nifty Bank. And valuation-wise as well, the Nifty Bank is looking pretty okay. So we need to bounce back today. This is the index that's going to drive the way. We'll have to keep an eye out on that front. Moving to the options data, because today obviously is the Nifty weekly expiry. We have the 23,100 call, 23,000 call, both of them fairly active in yesterday's trading session. So the bears are very, very confident we're going to protect the 23,050 odd mark. So that's the important level they're looking at. While on the downside, the 22,800 put, well, that was fairly active as well. So those are the crucial levels. The quadruple low around this price band, 22,700, 22,750. Resistance as well comes up for you on the screen. For an adventurous trader, since you're having the gift Nifty that's going to pull back 100 points or thereabouts, someone would like to put a stop of, say, 50, 80 points odd and maybe be a little bit adventurous in today's trading session. But keep in mind, it's the Nifty weekly expiry. So that's what will add some bit of volatility as well.
Okay, all right. Absolutely. We'll keep that in mind. Lots of action lined up, given that it's Thursday. Let's move on with the equity call of the morning. Asan Mukherjee of Nomura projects December 2025 Nifty in the range of 21,800 to 25,700. That's a wide range, implying a 5% downside to plus 12% returns from current levels. He recommends being highly selective and avoiding richly valued stocks. He says they're overweight on financials, consumer staples, FMCG, oil and gas, telecom, power, pharma, internet-based companies, and real estate plays. He says they are underweight on consumer discretionary, autos, capital goods, cement, hospitals, and metals. In their preferred stock portfolio, they have added Axis Bank and they've removed Nippon Life, Hyundai, and GE Vernova T&D. In the least preferred stocks, they have added Voltas and ABB India and removed Maruti Suzuki and Havells. Some pretty interesting and some non-conforming, non-consensus calls there as well from Nomura.
All right, let's get some flow picture in. We have Cameron Brand, Director of Research at EPFR Global, who's joining us now. Cameron, good to have you with us here, back in the program after a while, I think. Prashant this side. So what's the latest in that sense? We're getting continuous sell flows out of India, some $22 billion since the highs in late September, that is September of 2024. Maybe the numbers are becoming, on a daily basis, we get those numbers. The numbers are stabilizing at a lower level now. So just wanted to get that context from you, Cameron.
Right. So the answer is that with the really epic levels of policy uncertainty emanating out of the U.S., people are being very defensive, certainly over the last several weeks. Really, the focus has been on fixed income. Gold funds are finally seeing some significant money. And there's been sort of a re-rating of the U.S. interest rate picture. So we are starting to see more significant flows into inflation-protected bond funds. And financial sector funds are doing pretty well. Because of the assumption that interest rates will stay higher for longer. Tech funds have taken a bit of a beating recently. And in the emerging markets universe, really nobody's doing particularly well. Chinese funds are sort of seeing a steady drip of outflows. The attitude there seems to be, when you do something for me, I'll return. India, redemptions have stabilized, but have not sort of picked up. I continue to expect them to because in this environment, India has a number of high cards, which we're starting to get some attention. That is the relatively limited exposure to global trade and the fact that India does crop up in supply chain relocation conversations. But the higher oil prices have sort of counterbalanced that a little bit over the past couple of weeks.
Okay. But the silver lining, Cameron, is I just heard you say that India redemptions have stabilized. We'll take that. That'll be music, really. If you could just expand on that point, overall emerging market funds, are they seeing a lot of outflows or is it just lack of inflows? And specifically, what's happening with China funds? I mean, the market's just gotten red hot all over again, at least the Hong Kong market, that is.
Right. So generally, the only emerging markets segment that has been doing well in recent weeks is the previously much beaten up EMEA space, emerging Europe, the Middle East, and Africa. That I think is tied to a number of things. One is that oil prices have shown some signs of going higher. South Africa's gold story. And again, the on and off hopes that there will finally be some kind of settlement in the Ukraine. Global emerging markets funds have seen pretty consistent outflows, but at a low level. I think certainly people haven't completely switched off on emerging markets, but there's so many uncertainties about trade and U.S. policy in general that people just aren't willing to add to existing positions, and indeed are sort of cautiously trimming it. In the case of China, I think what we're seeing, honestly, is a bit of profit taking. Quite a bit of money went into China equity funds last year in anticipation of a rebound that took a long time to materialize. Now, as you say, Chinese markets are showing some real life. And I think some people who had been along for the ride are taking a chance to sort of get to the off-ramp at a decent price.
Okay, all right. Hi, Cameron. Good to see you. And Cameron, do you have a number to put to it with regard to the redemptions we're seeing from the Indian markets? What was it, say, a couple of months ago? What has it come down to? And, if you could give us a rough number.
So it peaked, there were a couple of weeks back there where, we were seeing 400 or 500 million move out. It's now sort of going down to the sort of 200 to 300 level per week. The trend is sort of cautiously downward, but obviously, 200 million going out each week of the funds we track isn't exactly an overwhelmingly positive sign. But as I said, I wouldn't. I continue not to read too much into it. There really isn't any emerging market at the moment that you can consider red hot or loved. And until some degree of settling down of U.S. trade and economic policy, I think is going to be fairly hard for people to feel comfortable stepping back into the emerging market space.
You're talking about, Cameron, those epic level of headlines or uncertainty? I guess both, right? Headlines causing uncertainty. I just want to quickly, for our viewers, put this up. So U.S. President Donald Trump, during a joint television interview, and this interview was to Sean Hannity of Fox News, It was a joint interview with Elon Musk. So both of them sat down with Sean Hannity, and he said that he had made it clear to Prime Minister Narendra Modi during Mr. Modi's visit to the US that India will not be spared from the reciprocal tariffs. Trump in this interview also said that it'd be unfair to expect Tesla and Musk to build a factory in India to avoid tariffs. He said, well, his exact kind of quotes were, if he wants to build it, he can build it, but it's very unfair, very, very unfair to us. And Trump said that he told Prime Minister Modi that US will charge whatever India charges. And of course, there was the usual sort of bit about the high duties on cars that India sort of, imposes. And they kind of sort of went back and forth about whether it is 70% or 100%. And but essentially just kind of once again putting the spotlight specifically on the fact that Donald Trump has now repeatedly on various occasions over the past fortnight or so mentioned India and of course tariffs here in India as well. So I think that at the margin perhaps causing a little bit of anxiety as well. Cameron, your quick thoughts. On this one. I guess it's headline watching, but it is tiring, right? Every day you got something. Most of the time it's a repetition of the old thing, but doesn't go away.
Right. Well, my take on it is certainly that Donald Trump has learned from his first term. Has really, worked out that for a U.S. president, your first 6 months are generally, unless there's an external crisis, when you get things done, and is doing everything he can to, set out his stall before the opposition coalesces, before the midterms appear on the horizon. But he's very transactional, and if his sort of stated positions regarding China are the ones he really holds, I think he will be looking to India as a potential ally over the longer term. So it's certainly very destabilizing.
Yeah.
Keep people on edge, but you do need to be careful here. Certainly, his first term suggested that everything was up for discussion, and that his negotiating positions are often established by saying,
take the extreme position and then kind of got that.
Yeah.
Cameron, great speaking with you. Thank you very much. Interesting chat as always, and good to have that perspective from you. What do we have coming up for you here on the program? 8:35, Rohit Java of HUL in conversation with my colleague Shireen. You'll catch a glimpse of that. What's the consumer growth here in India looking like as we get into FY26? 9 o'clock, you'll have Amit Anwani of Prabhudas Leader talk about the third quarter earnings from the defense companies. Yesterday, the sector did see some buying across the board. 9:20, Tahir Bacha of Invesco Mutual Fund. At 9:30, you'll hear from the management of MGL, Mahanagar Gas, those BMC directions and what the implications could be. 9:50, you'll hear from the management of PTC Industries. And of course, towards the end of the show, Indianomics, Lata discusses the top economic and trade implications on India because of what's happening out there. All this commentary coming in from the US administration. So that's the lineup here. Interesting chat. That's at 10:15.
Well, time to slip into a short break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I'll run you through the list. Bharat Forge, Bari Energies, India Glycols, IRJA, Tata Technologies. They'll all be reacting to positive news. Plus, 5 of them on the positive side, while you have 5 on potentially the negative side. Maruti, Mahindra & Mahindra, Hyundai, Tata Motors, and Orchid Pharma. Slip into that break, come back, get into further detail on all of these names.
Welcome back. Well, let's quickly get to a lot of the stocks. The headline we've already told you that Asian markets are selling off. They're very cautious, and we have to see if we can buck the trend and we can be the outliers for a change, because those are the colors on your screen. The Japanese market, Singapore, everything is down. As of now, the implied open is suggesting that we'll start in sync with our neighborhood, and then let's see what happens from there. But plenty of stocks, as always, on our radar to focus on. So we have our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. We are going to start off, I think, first up with Hormaz. Hormaz, good morning. And tell us, what's on your list today?
Morning, Surbhi, and some passenger vehicle related names will be on the list because of all of the news that is coming out from the SIAM closed door meeting, where they're saying that they are bracing for a 1 to 2% growth in passenger vehicle sales in FY26. The earlier talk was about a 3 to 4% growth. Now they're scaling it down to 1 to 2% for the next financial year, and they have cited multiple headwinds for that, be it weak demand, affordability concerns, declining entry-level sales, a fading post-pandemic surge, the inflation, the depreciation of the rupee, and geopolitical uncertainty. So multiple headwinds that SIAM has cited. Now for this year they expect growth to be absolutely flat, and for FY26 they expect it to be anywhere between 1 to 2%. But for two-wheelers they expect to be a little optimistic, where an 8 to 10% sales growth is what they're anticipating for FY26. But for now, the passenger vehicle stocks will be in focus, be it Maruti, M&M, Tata Motors. Expect most of these names to start off in the red today.
All right, Hormaz, we'll keep an eye on that. And good to have you back, Hormaz, looking nice and relaxed and, ready to fire all guns blazing. Good to have you back, mate. Let's hop across to Vivek. Vivek is here to tell us about some more stocks and news. Vivek, morning.
Well, good morning. A few stocks on the radar on the back of news flow that came in post-market hours yesterday. First on the list is Bharat Forge. The company's wholly owned subsidiary, Kalyani Strategic System, has signed a letter of intent with a US-based company, AM General. This is for supply of artillery cannons to the US market. Remember, this particular contract implies that there could be a scale-up as and when there is increased demand as far as the US company is concerned. The other stock on the radar is Warrior Energies. The company has received an order for supply of 362.5 megawatt peak of solar PV modules. This particular order has been received from Kaba Renewable Energy, a subsidiary of NG India, and the supply of modules is expected to begin in FY26. And lastly, Orchid Pharma, an inspection by the US FDA for the company's API manufacturing facility at Alathur in Tamil Nadu. The company has received 7 observations at the end of the US FDA audit.
All right, Vivek, thank you very much for that. Well, more stocks with news flow. Vamakshi is here with that list. Vamakshi, over to you.
Good morning, Prashant. Let me first start off with India Glycols. This company will be in focus because it has been allocated supply of 18.06 crore litres of ethanol under the ethanol blended petrol program. This is for ethanol supplier starting from the 1st of November 2024 to 31st of October 2025. The estimated value aggregates to somewhere around 1,264 crores. Now keep in mind that last year the company was allocated supply of 16.5 crore litres at an estimated value of 1,164 crores. So therefore, this is an uptick of almost 9% both on volumes as well as the value. Bodes well for the company going with the green for this counter. Apart from that, keep an eye out on Irida as well as Tata Technologies. That is because both of these counters will be joining the F&O segment from the March series. NSE will be making the F&O contracts available from Feb 28th onwards, and the details on the lot sizes, the strike prices as well as the quantity freeze limits will be made available on Feb 27th. So keep an eye out on both of these counters as well.
We definitely will, Vamakshi. Thank you very much for the details over there on those two. Let's quickly recap our list of stocks to watch today. The ones that have positive news flow are Bharat Forge, Warrior Energies, India Glycols, Irida and Tata Tech. The ones that have negative news flow around them are Maruti, M&M, Hyundai, Tata Motors and Orchid Pharma. Okay, so that's the stock list. So now, what about commodities? We have Manisha Gupta joining in for a quick roundup of all the overnight action. Manisha, morning. So what's the latest? What are you watching today?
Well, the first reaction is to the U.S. Fed meeting minutes, where the officials are watching progress on inflation before considering a rate cut. Well, that is something that hasn't gone down so well with the gold prices, but we still are holding around all-time highs. Gold actually is headed for an 8th weekly gain for this one. The markets also have seen metal prices continue to be very, very volatile. If you look at the copper prices, we are looking at a 7-month high on this one.
Okay. All right, Manisha, thanks a lot for that. Well, time to slip into a short break. Then up next, we'll connect with Dipan Mehta of Alexa Equities. He'll help us out with some fundamental stock talk. Welcome back. Hope you're having a good morning. As promised, Deepan Mehta is standing by to help us out with some fundamental analysis. Hi, Deepan. Good morning. Good to see you in. Deepan, let's talk about autos. There is this fear now because President Trump is making a strong pitch that he wants the US cars to be sold in India, which could add to the competition. And also we have reports that suggest that the PV sales growth is not going to be too much in the coming fiscal as well. What's your view on the auto stocks? And among them, which is your top buy?
Yeah, good morning, Nigel, and thank you for having me on your show. See, I don't think imports is a threat into India because of the cost factor, and these things take time to establish a network within India and to make a significant dent in the present auto players, I think is highly unlikely for the next few years or so. From a consumer's perspective, we may have more choice going forward. But apart from that, I think the more serious issue here is the kind of low expectation of growth which the CM has disclosed, and that certainly has put a cloud on auto shares. I would like to be a bit neutral to underweight the entire sector, although there are two stocks which we have discussed endlessly on your show, which we really are great fans of. One is M&M and second is Eicher Motors, both of which we have investments in. And I think within the auto space, these two companies should outperform, and they may even be able to outperform the Nifty and the Sensex. I think a lot of other companies may lose market share and also may find that going pretty much tough. But I'm pretty certain that these two companies should do pretty well going forward as well.
Deepan, hi, good morning. Let me press you on that M&M point because I'm pretty sure lots of people have that question right now. The stock, let's pull up a one-year chart on Mahindra & Mahindra, maybe a 6-month, because now with this whole Tesla fear, that decline is 15-16%. So the stock is close to the support lines that we've seen in the last 6 months, when at these zones. If you see, this is 12 months. So if you see the last 6 months, this is the lowest M&M has gone, and then it's always bounced back from there. We don't know if that happens this time or not. But Deepan, you're not worried with this whole Tesla entry, and if they do indeed manage to come in and offer cars at 30-35 lakhs, including the duty?
So I think it's all, the whole entire work is in process. One doesn't really know what exactly their plans are, what price point they will come, and what an impact they will make as well. I'm pretty impressed with the new lineup which Mahindra & Mahindra has got. And also one needs to understand that there's this farm equipment business of theirs which is doing pretty well. They have a dominant position over there, 40% plus type of market share. And with the kind of reservoirs which are full at this point of time, you could expect decent demand over there. Although it's slightly cyclical, but nonetheless, I think if you see over a 3-5 year period, that particular division has been a great value add. And if you compare M&M to a lot of other companies, I think you see the model lineup, you see the kind of products they have in the market, the demand which is there for the products, and their focus on this, UV segment, which is the fastest growing segment within the auto space. Gives us confidence that, okay, you could have a few quarters, 2-3 quarters where sales may be a bit challenging for M&M and rest of the industry. But 3 to 5 year view for both M&M and Eicher Motors is very positive.
Deepan, hi, good morning. Just two questions. One is, do you think we're in the, just what you're picking up, right? Are we building some base here slowly, steadily? Are we in that phase, especially for broader markets, mid and small caps?
Yeah, Prashant, I would think so. And, I've been quite cautious on the market for several months, if not quarters, and I'm gradually getting more optimistic. I thought the earnings season was not as bad, although a lot of analysts had very high expectations. And at the same time, I think that the steps taken by the government, that being the tax relief in the budget, this particular interest rate cut as well, higher liquidity, I think all of this will lead to an improvement in corporate earnings and GDP growth rates, maybe with a lag of 1 or 2 quarters or so. But markets are advanced indicators. And my sense is that large cap stocks are pretty much stable at these levels unless we see any additional bad news flow. Mid cap stocks, there may still be stock-wise damage, increased volatility, but investors should try and work that volatility and correction in mid cap stocks to their advantage. Because I still firmly believe that growth is in the small mid cap stocks, and if you want to look at a 3 to 5 year outperformance of your portfolio or create good wealth, then that's where you should be focusing on.
Maybe a repetition, but what have you bought lately, or what's on the watch list, Deepan, in that space?
Yeah, I think that there are many stocks on the watch list, and I may say the names here, but please keep in mind that these are stocks we and our clients may have invested in or looking to invest. So, we like the travel space, and there's a company called BLS International, which is into visa processing. A very impressive set of numbers, very positive commentary, good acquisitions done recently, which are earnings accretive. And we like that particular space, given that travel and tourism seem to have gone to the next level post-COVID. So that is one stock which comes to mind. Insurance processing companies also like Sagility, which is the US insurance processing company, came out with very good set of numbers, and that also looks quite interesting to us. MediAssist is another company which processes insurance claims for the Indian insurance companies. Its growth has been a bit tepid, high teens or so, but it's a solid compounding business. We like that particular company as well. And then, of course, the platform companies. Now, there are two companies where I would like to caution that short-term maybe some pain may be there, like Zaggle Prepaid and RateGain Technologies. We are watching them very closely because we like their business model. And at some point of time, I think when we see the present challenges kind of being dealt with, there could be great long-term opportunities.
What went wrong with Zaggle, really? I mean, there was, I think it's seen a sharp curve. Of course, I mean, compared to what it has done, that puts things into perspective. Had a one-way kind of a move, right? But it's given up a lot of that outperformance now. Are valuations more reasonable now, Deepan? Zaggle?
Absolutely. I think, Prashant, see, what has happened is that these 2-3 stocks were the darlings of the market, and a lot of funds bought it. A lot of momentum investors also bought it, and that bid the price up to a very high level. Valuations were in the 60, 70, 80s, trading 12-month. But then earnings have also improved and stocks have corrected. So valuations are a bit more reasonable zone compared to a business like this. And at the same time, the management commentary became slightly cautious. In Zaggle Prepaid, I think investors have concerns around the fall in the operating profit margins, which is because of the product and service mix. And in case of RateGain Technologies, I think there are delays in signing up new contracts. But look, these are companies, if you are invested and have the patience to invest for a long period of time, 3-5 years or so, they are great business models. They've created a nice moat around them. And they are hugely scalable because end of the day, they are like platform companies. So such corrective phases within these stocks are good opportunities, to look at investing in them in a gradual process at the price points that you are comfortable with.
Okay, so RateGain, Zaggle, some of the stocks on Deepan's radar. Deepan, stay on. We want to talk to you about consumer names as well and whether there's anything that you're liking after this correction. But before we get to it, let's hear from the industry giant itself. And these are words coming in from the top management of HUL. Q-commerce will increase the market size and it is helping to premiumize. Now, that is the view coming in from Hindustan Unilever's MD and CEO, Rohit Java. In an exclusive conversation with Shireen, he spoke about how budget measures and the RBI rate cut will create stimulus for better consumption. Take a look.
We're here talking about quick commerce and, what a story that's turned out to be, especially in the last 2 years. People had written it off and with good reason, because perhaps, in 2015, when it first emerged, there were many things that were not in place, including the digital ecosystem, microtransactions and so on and so forth. Why do you believe quick commerce is the success that it is today in India? What do you attribute the success of quick commerce to? And secondly, it's not just about 10-minute delivery. It has changed the consumer expectation across a whole host of sectors. Now, today, people want 10-minute banking, people want 10-minute food delivery, people want 10-minute, e-commerce. Everything is being measured from a lens of quick fulfillment. What kind of pressure does that put on someone like you?
It's an opportunity, first of all, not a pressure, because I think so few things that we see across markets that consumers, all of us as shoppers, will start to buy from different formats. We'll start in kirana stores, in supermarkets, and then e-commerce and different kinds of e-commerce sites and stores, brand stores. So omni-channel behavior is increasing in India, and it's happened across the world. People buy from 6-7 channels. I mean, you'd probably, even if you're looking at something, you'd probably surf somewhere else and eventually buy somewhere else. So I think that trend of omni-channel behavior is not uncommon, and it's here to stay. Therefore, we as a company got to serve our consumers and shopping missions wherever they are. And what quick commerce has done really is in certainly the very large cities where density is high, where actually consumers were already, shoppers were already calling and getting things done, delivered on phone or WhatsApp. it was an existing behavior, and therefore it wasn't that difficult. You know, it's hard to get around the city in terms of navigation and traffic and so on and so forth, parking. So what really quick commerce has found is it's found a shopper need. It's found a consumer gap. It's filled it. They've been able to do that at economic levels. So they've been able to create unique economics, and that requires technology.
Yeah.
And I think the tech now is really a big driver. I've been to dark stores of one of the platforms not very far from our office, and you can see the level of tech that's involved in efficiency of even a few milliseconds, the number of steps taken to pick something up, and all of that couldn't have happened.
Has it surprised you? Has it inspired you? Both?
No, we are very inspired, and we want to work. We are working with all of the big platforms, and two of our judges are from two of those big platforms here, and we're very honored to have them. They're our customer partners. We are all in. We're making sure that we serve this mission. We have a segregated portfolio. 80% of what we sell, mostly sell in quick commerce, is quite differentiated from Kirana stores. So it's a different shopping mission that we're serving. It's more convenience, and it's really that. It's basically convenience.
But is it expanding the consumer base, or is it just changing consumption patterns?
I think it's creating, it's feeding a shopping mission of I want it here, I want it now. And it does therefore removes the barrier to consumption. So therefore it will increase the market size, because it's just, you can get if something you need it. And I think it's also helping premiumize. It's largely a bigger urban metro phenomenon at this point. But I think the quick commerce platforms themselves are evolving their portfolio. We are going to be a very important part of their growth journey, because we create baskets. We can put in Dan, our head of our home care business, right here. If he brings in, I was being told by one of the platforms that there's not enough laundry as yet in their baskets. So the more we build the market, we'll upgrade the market. So as a whole, everybody will gain. I mean, it's not a zero-sum game.
Yeah.
But we've also got to make sure that we differentiate assortment and promotions to make sure that there's separation between a Kirana store shopping mission and a quick commerce shopping mission.
So over the next few years, 5 years is a long time in the world that we live in. So let me ask you much more near or medium term. How much do you see the mix changing, sales being driven via both e-commerce as well as quick commerce for you?
We have given a number that it's high single digits for us and growing fast. And we do expect, general trade or traditional trade to remain heart of our business, because it's very large. It's 70-odd%. So it'll always remain a very important part. And our business system will largely be anchored around, distributive, inclusive, and a Kirana-centric model. But there would be, of course, a high share of e-commerce of different kinds, whether it's beauty.com or it's grocery.com or quick.com or even marketplace. There are different models that are emerging. And modern trade, of course, or supermarkets, modern retail is also growing. And all of this is now going to sort of lower tier cities. And we have many, many years of growth. While the share of retail, Kirana or general trade will come down, but we'll be on a much bigger cake. The pie is expanding as well. So I think there's a lot of opportunity at this stage rather than any threats at this point in India.
Speaking of opportunities and speaking of the market as well, Rohit, we've seen several changes happen over the last few months. We've got the budget delivering an income tax cut for the middle class, much needed. We've also had the RBI bringing down the interest rates. Do you believe that all of this is now going to provide the fillip that's been needed? Everyone's talking about the need for a consumption boost. Both the government and the RBI have done their bit. Do you expect things to take off? Are you starting to see any visible indication of that yet?
Yeah, the answer is yes, I do. I think the shift in the financial strategy started to shift towards more consumption from this budget, and even the last one budget that came a few months back. I think all of these moves are quite material, because we're talking of 30 basis points, around 30 basis points of impact of GDP. It's a large sum of money. It's definitely going to create stimulus for consumption. Importantly, I think maybe what's also helpful right now is that the rural economy is stronger. After many years of inflation and monsoon issues, I think this year the reservoirs are full, the agri-production is good, rainfall has been above average, and we can start to see already the signals of stronger rural growths than we did in the years before. And I think the urban consumption crunch that we've seen the last few quarters might take a few more months or quarters to wane away, but that should normalize because it was on a high base. So I do think that given that the macro factors are turning in the favor of consumption, the institutional policies are beginning to bias that, and that some of the things that we can't control, such as weather, has also turned in our favor. And India will always remain a very underpenetrated, big headspace of consumption. Though I do think that as we go in the quarters going forward, the consumption economy, or economy driven by consumption, is definitely going to look better. How long it takes, I can't say. I'm not a soothsayer, but I'm optimistic, and I think that all the signals are positive at this point.
But it's still perhaps a quarter or two away.
We are not waiting for that, so we are already doing what we can do, which is go where the growth is and control what we can control. So we already have a deep rural infrastructure. We get to a very large number of outlets in the country, almost 70% directly weighted value distribution. So we intend to go deeper and also invest more. And we already have brands for rural markets that are absolutely have a great product fit. We are also relaunching some of our strong powerhouses like Lifebuoy and Glow & Lovely, some of our brands like Clinic Plus, Sunsilk, they're already quite strong. So, yeah, I think we are not waiting. We are already investing to basically be ahead of the curve as things have started to sort of turn.
All right, there you have it. A very, very confident-sounding Rohit Java saying that macro factors have turned in favor of consumption, and he's extremely bullish on the quick commerce channel as well as part of the overall distribution strategy. Let's go back to Deepan. Deepan, I don't know if you could listen into some of that conversation or all of that conversation, but would you be convinced, I mean, hearing Mr. Rohit Java, you'd imagine there's absolutely nothing wrong, and he's saying things will turn next 1-2 quarters. It'll get better thanks to the budget boost as well. But the fact is, beyond all of this, these companies are still delivering only 3-4% volume growth. Would you buy anything in the staples basket?
Yeah, Sylvie, I think very good interview, and Shaheen got the best out of Mr. Java. He sounded very positive after a very long time. But, you're right, this 2-3% type of volume growth doesn't really interest us. And if you want to get decent returns, create long-term wealth, you need to buy companies which can grow at 15-20% top line. I don't think any of the FMCG companies in India have that kind of a potential anymore. A lot of the categories they're operating in are very, very mature. And you may have mild uptakes and good trading rallies in them because of very low floating stock. But these are not stocks that I would hold for 3, 5 year, 10 year or so to expect decent returns.
Okay, all right. Deepan, I wanted to ask you about hotel stocks. Yesterday they all burst up. Some of them have corrected a goodish deal. But in yesterday's trading session, a lot of them did very, very well. From that pack, what's your pick?
All I can say is they're doing well because of this wedding season, which has gone quite berserk in terms of number of weddings and the way people are spending on banquets. At the same time, I think there's this religious-related travel also that's making an impact. And overall, I think the hotels are in a sweet spot because of shortage of good quality hotel rooms, and typically these take 5 to 7 years to come on stream. So very positive on hotels, even from a consumption point of view. Although Indian Hotels is the best, I would say, stock in the category, but a dark horse could be Lemon Tree, which is focusing more on managing of hotels. And we are seeing those improve, the management revenue contracts improving significantly quarter on quarter. And that's a very good model to process within the hotel industry. So that could be the outperformer within the hotel space, according to us. Having said that, it's a company in which we and our clients are invested in.
All right. It's also come off the highs, not? I mean, yeah, 160, 165 was the high at about 130 right now. We have to take a quick commercial break here, so allow us to do that. Some technical trading ideas also coming up on the other side. 9 minutes to the pre-open session. Stay with us.
Welcome back. Well, let's get in Sudarshan Sukhani as well as Mitesh Thakur join us to help us out with some technical trades. Good morning, gentlemen. Thanks a lot for joining in. Mitesh, you go first. The GIFT 50 suggesting we pull back a little bit to kickstart trade. Asian markets as well are in a bit of a tizzy. What would you do?
Morning, Daniel. I think that same logic continues that, on the downside, we have that 22,800, 750 as the support area, and till we cross and close about 23,100, there will be no breakout at the upper end. So you try and see if there is a long opportunity at 22,800, 780. From there, take a 60, 70 point, 80 point kind of a stop loss and trade long, try to book profits as we get near to 23,100. This has worked for the next few days, for the last few days. But the important thing is that someday you might see that the market does take the stop off, and then I think that will create some kind of shorting opportunity. So for the timing, we are just waiting for this level to respond and see if there's a bounce back which is strong enough to give a short-term reversal, or eventually I think it will break. But till then, I think this logic of the contracting market, you try and buy near support and sell in a bounce back. I think that works for the next few days.
All right, gentlemen, good morning. Thanks very much for joining us always. Sudarshan, what about you? How would you look at this market? Banks index, of course, looking a little stronger than what the Nifty is doing.
Yeah, good morning. The banks are a little stronger, but that's very relative. See, for the last few days, I have been consistently saying, do not trade and do not go long. Yesterday, the market went down, went up dramatically, again came down, again came up. This is not an environment for trading. And apart from the intraday moves, even for swing traders, the market is not giving a sense of direction. It's not going up. It's not saying I have established a higher level and I'm sticking to it. That's not happening. Apart from that, the market is in a narrow range. And my worry is that this narrow range could easily break on the downside, leading to a significant new downtrend. That hasn't happened. So I'm just saying that this is a possibility. Given the confusing scenario, the index is not a tradable option at all.
All right, let's talk about stocks then, Sudarshan. Tell us what are your stocks.
Yeah, well, the stocks, there's a list, and just to be cheerful, there's more of a buy list. Jubilant Foods is a buy with a stop under 695. Manappuram is a buy with a stop under 195. Infosys, that big stock, is an intraday short with a stop above 1845. And finally, Indigo is a buy with a stop under 4300. Yesterday's price action in small cap and mid cap suggests that maybe they can outperform at least for the short term.
Okay, all right, got it. And Mitesh, what about you?
I have a mix of buy sell calls as well. On the buying side is Hindalco with a stop at 619 for targets of 640. Now, that's also a stock which I've recommended time and again because that's one stock which is showing signs of an uptrend. Then Dabur is a sell call with a stop at 511 for targets of 490. Bata is a sell call with a stop at 1272 for targets of 1220. And I have a buy on Angel One, which is a conditional buy with the disclaimer that we have some small futures positions over here. So there's vested interest. Angel One is a buy if it starts trading above yesterday's high of 23, 34. So buy above that, keep the stop below 2300, look for a target of around 2400.
All right, we'll come back to both of you. Thank you very much for now with those trading ideas. We're going to take a quick commercial break here. 3 minutes to go for the pre-open session. More coming up.
Welcome back. Well, we have Deepan Mehta who's still with us. Deepan, I wanted your view on BSE. Yesterday towards the end of trade, it saw a big spurt and there was a large buy that actually had taken place, a big large trade around, I think, 5,500 rupees odd. The stock's not cheap, the market's a little bit jittery, but this one on dips is getting bought into. You have an unlisted company like NSE out there as well. The share price thing has gone up by around 2.5 times in the last 2 years or so, but in the same time, BSE is up by more than 5 times. Your take on the stock?
Nigel, I think that, considering there's so much of interest in exchanges and the fact that NSE may get listed, we are seeing a good amount of interest in BSE Limited shares as well. And do keep in mind that when NSE gets listed, it will be listed only on BSE. And that in itself can boost the volumes of BSE in the cash market and subsequently in the futures and options market if NSE were to be added to that list. So that's, like one positive opportunity on the horizon. But look, these businesses are cyclical, whether it's NSE or BSE or any exchange for that matter. And right now, I think you are paying premium multiples on earnings, which have seen like 3 to 5 year type of a bull market. So I'm not sure that at these levels, the risk return profile will favor you. It is expensive. These exchanges that we bought when we are in a solid bear market and volumes are completely off, and you know exactly what the profit position is at those points of time. So I would avoid both PSE and NSE. And in our opinion, I think a more interesting exchange to look at very closely, again, disclosure, is MCX, where I think there's still greater potential to gain revenues from the options trading over there.
Okay, MCX could be the more interesting one. Got that, Dipan. We've made a note of it. Thank you very much for being with us today and weighing in on a lot of these different stock ideas. We look forward to the next call very, very soon. Well, let's quickly move on and put the spotlight on the defense space. Now, we all remember yesterday there was this big surge coming back into all kinds of defense stocks, not just PSU defense stocks. A lot of the private sector, smaller companies as well did very, very well. So is the worst over, or is it way too early to jump the gun and jump the gun? That's quite literally to call that. Let's discuss this with Amit Anwani, who is from Prabhudas Leeladhar, and he tracks this space at PL. Amit, great to have you on. So really just that. I mean, these stocks have been beaten down quite badly. Many of them are off 30, 40, almost 50% from their 52-week highs. Valuations have come off. But the thing is, it's a very different market as well now. The market is worried about going back into the old stars, the old favorites. What would you advise on the defense space, looking at fundamentals?
Hi, Sobi. Thanks for having me. So you rightly highlighted, and we have been saying that that defense is something which we have to see longer term because of the execution cycle and the prevalent changes which is happening in the sector, the government's focus over past 7-8 years, and the kind of 10 to 15 years replacement program across aircrafts and many other verticals in defense. Having said that, as you rightly pointed, valuations were about 40 to 50x if we check 6 months back. Today, for me, I think the valuations 2 year forward appears to be around 25 to 28x for defense electronics, around 28 to 30x for the OEM companies. I think for many of the companies, there's still a very large pipeline which is waiting. For example, MDL, which we don't have under coverage, but they're talking about additional submarines for 30,000. Bharat Electronics stocks very strong with respect to the order pipeline, QRSAM order, which is kind of 25,000, additional MRSAM order, which is again 14,000. So I think pipeline is very robust. We saw 9 months performance by HL. Bharat Electronics was quite decent for this 9 months. I think the only issue was the very steep valuation and the supply chain issue at some places, which leads to this correction. And I think I'll be selective. And we have been recommending Bharat Electronics at this point. We find it attractive.
No, I know you like Bharat Electronics. You also like HAL, I believe, Amit. Now, what is the run rate, revenue or EPS run rate that these companies will have to deliver for sustained stock price appreciation, given where the multiples are? And in this mix, if we throw in any of this, US strategic defense ties business, because the US is pushing us to buy all kinds of things, including C-35s. So I don't know if that creates any risk, or do you think, at least for these two specific companies, since you like them, whether it maybe only opens up more opportunities, because then the subsystems, etc., need to be manufactured here? So just tell us both, what is the expected EPS CAGR, earnings CAGR that you will, you want these companies to deliver to justify that positive view?
Right. So I think talking about HL, as we all are aware that there has been an issue with respect to deliveries, though the management is confident that the engines will come. And I think we have been building in some 12-13% CAGR. If at all the deliveries come on stream, we are talking about currently they have the line to deliver 16 aircrafts. They're expanding to 24 aircrafts delivery after 2-3 years. So definitely this will ramp up the pace of execution in the coming years. The company is also talking about the outsourcing the pre-integrated supplies and modules so that they have better assembly in future to the private sector. We have seen in the past the wings and few of the components of LCAs are already kind of outsourced. So I think this will gather the pace for the next decade. And as we are all aware that there's a massive opportunity. We are at just 31 squadron versus 42 squadron, and we're talking about at least 200 aircraft replacement over the next 10 to 15 years. So I think pipeline is very strong. We're talking helicopters also. So I think sustainably it should be 12 to 13% CAGR, which makes us comfortable with the stock seeing moment. And at the same time, they are already at 1,30,000 book. We're talking about 2 lakh crores of more orders. So all this indicates that on a longer horizon, despite this short-term challenges, which we understand, I think the 100 will be higher than past decade. Yeah.
And Nigel, I know you were sorry. Just one follow-up on HAL, and this is slightly longer term, but I mean, everything is being disrupted by technology, right? I think there was Elon Musk in one of his interviews. He said he was sort of talking about futuristically about whether drones will replace planes and the need for fighter planes and things like that. And drones are getting advanced all the time. So do you need a pilot in there? Do you think it's something to keep on your radar? I mean, there's no way to know, right? I mean, we as lay investors or commentators would not know. This is, but a lot is happening. The Aero Show, for example, there were, I'm told, 60 drone makers there, 60, or each kind of trying to outcompete each other and trying to, pitch to the defense forces, etc. Just your thoughts, Amit, quickly.
Yeah, I think, as you rightly said, that could be the future, but currently we have been taking a lot of drones, outsourcing a lot of drones from Israel, and we don't have our indigenous technology. We saw same for the aircraft taking many years. I think developing technology would be very crucial for us to move. Otherwise, I think we are largely currently importing drones, and drones could be definitely the future for the future wars happening. Yeah.
That's a little surprising. I'm sorry, a bit of an out-of-syllabus question. You're saying, I mean, we have been importing drones, but then you have even listed companies, Idea Ford, Zentech, they're big in drones, which also brings me to the other question. Beyond the public sector giants that you've named, HAL and BEL, which are the private sector companies that still offer some value, good growth? Because for Zentech, we remember the conversation with the management. The thing is, they've been executing their order book. Now it's come down to 800 crores. They're saying they'll get more orders in the next 1-2 quarters. So what do you like in the private sector space?
Right. So I think all the defense electronics companies we have seen in private space, the profits doubling and tripling. When we talked about localization and building the vendor base for OEMs so that the OEMs fast track the deliveries. We saw numbers for many companies, though I don't cover much of them. Data Patterns, Astra Microwave, Zentech, Apollo Microsystem, the profits increasing. And I think as we have been hearing that to fast track the deliveries by OEMs and get more orders, definitely there has to be a private vendor base, including the big boys like L&T, Tata Advance, which are already attached to LCA deliveries are also benefiting. So I think the way forward for next 3 to 5 years is to build the vendor ecosystem, and defense electronics is something where the DRDO is already promoting the collaborations in startups. They are already incentivizing the startups. So I think a lot of smaller private defense companies currently listed and might be in the startup ecosystem have very strong growth seeing for next 5 years.
All right, Amit, we'll leave it there. We had more questions, but out of time. Appreciate you joining us here on the program today. Well, let's talk about the 9-10 calls. Sudarshan is here. Mitesh is here as well. Sudarshan, you go first. What do you have?
Consider buying Manappuram with a stop under 195 and avoid the Nifty.
Avoid the Nifty, buy Manappuram. It had a strong day yesterday, very strong day yesterday, back above 200. Mitesh, what about you?
A sell on Dabur for targets of 490.
Okay, sell on Dabur, 490.
I think Manappuram will have to be bought in cash market as well because it's in the ban.
It's on the band, yes, the F&O side. Well, let's talk about two other names. NHPC, we had the management, by the way, with us yesterday, and Tata Power as well. Vivek is standing by to tell us why. Vivek, morning.
Well, good morning. NHPC, like you mentioned, we had the management on our channel yesterday. Today, CLSA has come out with a note. What they've done is they've upgraded the stock rating. They earlier had an outperform stance. Now they have a high conviction outperform stance. However, they've marginally trimmed the target price from 120 to 117. They are largely factoring the higher capex spends that the company had alluded to yesterday. Now, what they're saying is that the 25% stock correction that has been witnessed has given the chance for investors to accumulate what is essentially a very inexpensive utility with at 12 times FY27 price to earnings. What is it? Are the key catalysts? They say that the start of the Parbati 2 hydro project that the company said yesterday will start next month. That they believe will lead to significant earnings growth. Along with that, the entry into shorter duration regulated pump storage and a likely 2x increase as far as regulated equity from FY24 to FY28 is something that they see as the key triggers. Now, talking about Tata Power, HSBC has upgraded the stock to a hold rating from an earlier reduced rating. They've raised the target price to 345 from the earlier 300 rupees a share. They say that the sharp fall that the stock price has seen largely has been driven by events outside of the management's control. Some of the reasons that they've attributed for the fall include weakness in power demand, a slower signing as far as power purchase agreements are concerned, a slower signing as far as privatization of discoms is concerned, and also delay in multiple projects that the company has witnessed. However, what are the key triggers according to HSBC going forward? Solar module and cell manufacturing is ramping up quite smartly. They've already achieved H1 profit and they have reached 17% EBITDA margin, and they also are constructive on the module and cell margins going forward. Along with that, the solar EPC business is something that has turned around. So two upgrades coming in on the power space, NHPC as well as Tata Power.
Okay, all right, Vivek, thank you very much for that. Watch out for both of these stocks. In the pre-open, by the way, the large cap index is falling a little more than the mid cap index right now. Nifty is down about 0.5% in pre-open. Mid cap index is down about 0.25%. On the Nifty, the trends are, I was watching for these auto stocks, if they're really reacting to the SIAM data, but not so much. I mean, they're okay right now. Not too many deep cuts on auto names. Let's quickly move on. Rima is joining in and she's watching out for Cyient. There is a new appointment there at Cyient, Rima?
Yes, indeed. So, Cyient has appointed Mr. Sukumal Banerjee as the CEO and Executive Director, effective immediately for a period of 5 years. He will also serve on the board of directors. Remember Cyient, when they came out with their numbers on 23rd of Jan, one, the numbers were disappointing. The company had lowered the guidance. But secondly, there was a surprise resignation of the CEO. And that triggered a very sharp reaction in the stock price. The stock fell from levels of, 1,750. It was down more than 20% on that day. And since then, the stock has been struggling. So this announcement of a new CEO provides, a lot of relief because it's an overhang which is out of the way. A quick word about the new appointee. Well, he's right now joined from the CEO of a digital engineering firm, but he spent close to about 3 decades at HCL Tech. Back to you.
All right, Rima, thank you very much, and good to see you back with all the
teeth.
She's a brave lady, huh?
No, let me wisdom on IT. Rima, wisdom?
Lots of wisdom.
All gone.
All right, thank you very much for that. Well, that's Cyient in focus for you. We have the market open coming up in just a bit from now, and we've got 10 seconds. So what do we have? First rates, let's look at indices first, and then we'll get into individual names. A third lower on the sensex, a quarter lower on the mid-cap index. Bank Nifty is, it's like fluttering between green and red. But I think we'll have firmer rates coming up. They're all on your screen now. It's lower. So about 100 points lower on the Nifty, 22,840. I mean, every day like clockwork, at least for the last 2 days, you used to start around this 22,830, 840 level and not below. And then, of course, like yesterday, there was a bit of a recovery, and then that recovery was sold into and we ended flat. So let's see what happens today. The Sensex is down 300. You've got the Nifty Bank, which is down about 180 points, 0.4 lower. IT index is up on your screen. And 660 higher and about 700 lower. Yesterday, advanced decline was quite positive. Today, it's mixed. It's almost evenly matched, at least at the word go. The heat map will come up on your screen as well. We look at what the Nifty 50 screen is looking like. Should be more down than up, looking at where the indices have opened. But let's get to stocks. Surabhi.
You know, it's already looking good, Prashant, and I'll tell you why I'm saying that, because look at the mid-cap index. It had a cut of about 0.6% at open. It's already recovered. It's flashing a little bit of green, and the bulls will really want to see, this continue. But anyway, on the large caps, let's see where the pressure is coming in from. ITC is down about 1.5%, and okay, now the auto stocks are falling, taking note of the SIAM commentary. So Maruti 1% lower, M&M is lower by about 1%, iSure is down by about 0.5%, Hero is down by about 0.5%. So yes, auto is a bit weak. Then there is HDFC Bank. It's exerting a fair amount of downside pressure, 1% lower. Other heavyweights lower include L&T. There's TCS, which is lower by about 0.5% as well. You've got names like Titan and Tata Consumer, Nestle on the consumer side. So a couple of these consumer stocks are lower. Lever itself is down about 0.5%. So consumers also weak. Now let's talk about what's actually moving higher. There's some buying on a couple of financial names. Shriram Finance is the Nifty winner at this point in time, 1% up there. SBI Life and HDFC Life. The life insurers are having a pretty decent morning, so far at least. And Infosys is fighting hard to stay on the top side of the screen, but let's see if it can continue or not, because otherwise it's looking a little weak. The Nifty fall, by the way, is about 80 points at the start. Some financials up. Reliance is a big one. It's sitting on the fence. Depending on which way it goes, obviously the Nifty will follow, but 80 points lower for the time being. Nigel.
Well, let's pull up a few stocks. Yesterday, JBM Auto, they won a big order towards the end of trade. That stock is seeing some follow-through buying today. It's up closer around 3%. Acme Solar, Nimesh had told us in D-Street chatter yesterday that, in fact, that was seeing some bit of interest from larger hands. In today's trading session as well, that stock is up closer on 2.5%. So JBM Auto, Acme Solar, both of them are higher in trade. Borosil Renewables, it's been moving from circuit to circuit. Last few quarters have been weak. The management has promised better times ahead. They're talking about margins back at around 30% because of the duties that they've got in terms of protection for the domestic industry. It's up another 5%, moving circuit to circuit. Vare, they won an order, I think a small one, 280 or 300 megawatt of order for their modules. So that one as well had opened up initially in the green. I think, for these companies, the big test will come once that lock-in opens up. For the time being, the stock is up 2%, building on post yesterday's 2% returns. Zen Technologies, at least for starters, that's building on to gains. That is one of the top volume gainers today. So I think we should pull that up. That's up closer around 5%, following up yesterday's big surge that we saw of around 10%. Remember, the stock is still 45% off its peak, but for starters, it's higher. Cyient, they have a new top boss, who's been appointed, and the street likes that. So Cyient is a stock that's up closer around, I think, 2.5% or thereabouts. Mr. Banerjee has come on board. The stock had corrected from around, I think, 1,750 all the way to around 1,400 rupees. So that as well is popping back up. NetWeb, the stock that's down 40% in this year, well, that stock, in fact, has opened up in the green and is trying to pull back some of those losses. On the losing end, Bikaji is a stock that's giving back some of that rally that we saw in the last couple of trading sessions. So Bikaji, I think, is down now close to around 3% or thereabouts. So it's a negative start. Advanced decline ratio, even Stevens as we speak. Interesting times. The Nifty is defending the 22,800 mark yet again.
Well, so we're down about, 70 points now, and we're at 22,860. Just a couple of more names. Rate gain is something we highlighted day before yesterday, and this morning Deepan had it on his watch list. So from the lows of about 500, actually maybe it fell, it did fall under 500. This was on Tuesday. The low was about 475. It's back to about 516, 515, 516. Decent sized volumes as well for this point. There is nothing extraordinary, but decent sized volumes. Delta Corp is, I think, almost back in 3 digits. So almost, not quite. Delta Corp will come up on your screen. Again, I mean, here the low earlier this week was about 89. So that's bounced. There is a car trade which is coming up with small gains, but nothing big. There is Tata Investment Corp, which was up 14% yesterday. And it's up another 7%. Tata Investment Corp is just a sort of, stock holding company. It has a high quality, mostly large cap, some mid cap names as well, which it holds, and that's essentially the business. So it's like a fund. You could buy the stock and it kind of reflects the value of the underlying portfolio, and that's about 8% in the green. That's 25% in 2 days. Vivek was talking about NHPC, that's about 1.33% higher. And I think the others we mentioned, Zentech, Nigel mentioned, Netweb we mentioned, Netweb back about 1,500 rupees. And maybe throw in a Tata Tech as well, which is up about 2.6, 2.7% at this point in time.
361, wealth management. Just thought I'll put that up. I think the market's trying to see if it wants to go back to some of these capital market plays. Yesterday, BSE had a great day. Let's just pull up BSE as well. And this morning, it's 361, which is showing a gain of about 3%.
Absolutely. Let's just look at maybe IIFL as well, since we're looking at this one. IIFL is the other one, which is, but that's a NBFC. But 313, completely bombed out, right? But the top volume-led loser, by the way, is, guess what? Mahindra & Mahindra. M&M is down 2%, 2.5%. So, and it's got humongous volumes. It's number one volumes on the NSE. Mazgaon, and I think I see one or two other defense names, they were all up 8-10%. Mazgaon at least is down 2.5%. And the other one, which I've not seen any news flow with regards to, is Credit Access. Credit Access was down 7%, 8% by close yesterday. It's down another 3%. So 867 on Credit Access. It's been in this 850 to 1100 kind of zone for a while now. And once again, it's back to the lower end of this range. But let's welcome in Tahir Badshah, who's with us, Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Great to have you with us here on the program. Thank you very much for your time. Do you believe, Tahir, that this is base building, some kind of bottom formation? The process is on. What's your sense?
I would like to think so. I think the market is trying to get a hold of itself around this level after having seen a very vicious correction over the last month or so. I would think that we had certain issues as far as our domestic economy is concerned, particularly with respect to growth, as we all know. And I think some of the measures which have been undertaken in the recent past, both by the regulator, the central bank, as well as the government, I think should probably help us to stage a slow recovery. It will be a slow grind as we see it probably in the first half of calendar year 25. So I think by and large, from the domestic standpoint, we are kind of fine. Of course, the global environment still to our mind remains tough. And we'll have to see how this whole thing pans out with regard to, the entire world trade situation. I think that's a lot more belligerent than I probably initially estimated myself. And I think we will probably have to face some consequences of that as well. So I think it's been a lot more belligerent compared to not just for India, but even for the rest of the world. And I think that's something which probably will, be a headwind for the market for some time.
By the way, I just want to pull up Mahindra & Mahindra once again. Prashant was pointing this out. The stock is very, very precariously poised. The only reason I'm saying that, of course, our chartists will know better, but it's now at a 6-month bottom. I mean, this is, if you talk about the trading band that M&M has been in the last 6 months, this is exactly where the stock is, 2,700. So these would be crucial levels. That chart will tell you the story. Now, whether it breaks this 6-month range or not, we will see. But there's a lot of additional pressure coming in. Let's pull up once again maybe a 7-day chart. We've been showing you that what the stock has done. 7 days has been absolutely pummeled, 14-15% gone. And this ties in, 13% down in 7 days. This ties in, Tahir, hi morning. It ties in with exactly what you're saying, right? This tariff issue or whatever's happening on negotiations with the US, they are beginning to act up. I mean, a part of perhaps why M&M is falling, maybe you could say attributed to profit booking. Stocks had a dream run. But there is genuine fear, right? There's genuine fear about what happens if US automakers start, rolling in on Indian roads, if those tariffs are lowered. This morning, anyway, we've got a very bleak outlook from SIAM, talking about just 1 to 2% growth in PVs, X of SUVs. SUVs are doing well. How would you look at not just M&M, but in general, the large cap auto space, which has anyway failed to fire in the last many months, barring, 1 or 2 names?
So I agree with you, Sylvie. Like as I said, we are going to probably see some of our Indian industries being at the receiving end of things as a result of this whole reciprocal tariff issue. And probably autos could be one of them in some way or the other. And that is something which has been very prominently highlighted by the US president as well. So I think to that extent, that is something which there will be a few other sectors as well, in my view, I think, which will probably have to see as to how either we get impacted due to lowering of import duties in the reciprocal process, or probably we see higher import duties ourselves on certain products. and which wherein we will probably have to be, we'll have to contend with as to whether we can pass through that cost or not into the US system. So I think those are things which will probably matter, and that is something which will not immediately resolve. We anticipated some part of it, like as I said, it is a little more vicious. And we'll have to probably be a little more careful about some of these sectors which are potentially at risk.
So what is your current stance, Tahir, on both autos, large cap OEMs, as well as ancillaries? Because there's too much change going on. When Bharat Forge this morning announced an order into the US, which is great. But again, we need to see what happens with tariffs. So what are you doing? Are you buying this weakness and this weak phase in autos? And what about ancillaries?
We've tried to, like as we've done in most other sectors, even within autos, I think we've tried to kind of, position ourselves in pockets which are a little more resilient compared to others. So in every sector, for that matter, we'll have to do that for the coming some time, where we will have to differentiate between performers or executioners versus those who are probably not able to execute as well. And I think there'll be some segments which will be at higher risk to growth compared to others. But I think at this point in time, for sectors like autos, etc., it is very important that we get a boost as far as domestic growth is concerned. We might probably need that for some more time till the time this global issue settles with regard to tariffs. So I think it is important for the government at this point in time to just go all out in terms of supporting growth as far as the domestic economy is concerned.
Hi, Tahir. Good morning. Good to see you. And Tahir, two themes that did well and the street was very excited about was EMS as well as quick commerce. I think you as well were quite positive on both those two. Both of them have cooled off a little bit. Now, does it make it even more attractive, or would you want to wait by?
We've, at least as far as quick commerce is concerned, I would say that we have nibbled into it, especially in this correction. I think it'll take, again, here to the food delivery part of the business and most of the companies which are around is well understood and is well discounted. And, to that extent, that remains a reasonably good support as well for the entire enterprise as such. For quick commerce, of course, we will probably, we will go through a little bit more grind compared to what we had thought earlier. And we'll have to probably allow for competition to kind of settle down. That will probably take a little longer, in my view, compared to what it has probably been for, let's say, the food delivery business for that matter. But I think currently, market has been in that mood where, by and large, it is almost starting to attribute zero value or very little value for that matter to the quick commerce business. And I think it's not that extreme either. So I think that is probably what is giving us that confidence to nibble in.
A point taken. What about Tahir, pharma as a space? Again, in the context of what we've heard, all right, the 25% tariffs on pharma imports into the US, which Trump is talking about. One argument which is pretty straightforward to make is that who wants higher cost of drugs, right? Medicines. But on the other hand, I mean, one doesn't know. They're talking about reciprocal tariffs. Have you looked at, have you and your team looked at what this does to Indian pharma?
Yeah, so, I think this is again something which we have to still, we'll see how it evolves, because we don't really know exactly what these specific tariffs could probably involve. There are two sets of considerations here. One is to neutralize the deficit at an aggregate level, and then it is also about reciprocal tariffs. And I don't think it is one versus the other. Both will probably happen simultaneously for every sector, and so goes for pharma as well. So again, coming back to the same thing that we'll have to probably once again, differentiate. There are some companies which are at relatively higher risk compared to the others. I think some of the, my sense would be, and this is something which I'm not fully confident about, but I would still like to surmise that some of the more, companies which are at least operating in some of the more critical areas, CDMO, etc., probably should be a little more better off compared to what it would be for the others, especially those who are in the generics business. So I think that is where once again we will have to probably differentiate and wait for the final print to come through. But this is once again a sector which could be in the throes of this dilemma.
Here on the market as a whole, what's the sense? And particularly, this question is pertaining to the mid-cap and small-cap space. And you've been a master of the broader market for so many years, right? And I think that's the issue. People don't know whether to start venturing in now, go and buy. In fact, there are some AMCs which have recently launched small-cap funds mid-cap funds as well. So is this the time to go in, or do you still wait? You've seen these cycles before. When do you know that the worst of the broader market capitulation is over? What are those signs?
No, so we always have different contexts and different conditions which are surrounding every correction and every rally, which we have seen in mid caps and small caps. And, so we had our own domestic problems at one point in time in 2018 when we last saw the very punchy crash in mid cap and small caps. And this time around, we have a completely different set of conditions, probably a little more global led, somewhat local led as well. But I would like to think at an aggregate level, generally, these are drawdowns which do indicate a start. You never know when to exactly time the bottom. You never get that unless you're very lucky. But I think there's a good time to start. I think the risk rewards are now getting a little more tolerable compared to what probably they were a few months ago. It will be a market which will probably a little more differentiating, nuanced. We'll have to probably build our portfolios carefully going forward in order to ensure that we at least manage to get better than system rate of growth. And if we can probably do that, then I think there's a fair chance of being able to outperform over the next couple of years.
All right, Tahir, on that optimistic note, we will wrap up this conversation. Thank you very much for joining in and giving us a perspective on the market. And we already see our next guest ready for us. So let's put the spotlight now on Mahanagar Gas. Of course, there's plenty to discuss with the management, but the latest headline was BMC directing all the eateries, bakeries and hotels and roadside vendors here in Mumbai to switch to clean energy as well as eco-friendly fuels. Let's discuss this and a lot more with the management of Mahanagar Gas. We have with us Mr. Anshu Shingal, MD at MGL, joining in to take a couple of questions. Mr. Shingal, thanks very much. Good morning to you and thank you for joining in. We really want to talk about what this BMC measure means and how meaningful it might be for volumes. But before I get to that, just to sort of understand the bigger issue, which obviously was plaguing not just Mahanagar Gas, but other city gas distribution players as well, which is how much of this APM gas will companies actually get? I mean, just going over history, the market, sold off big time thinking you're not going to get as much APM gas, but then it was hiked up. I think now it's 50%. So let's just talk about MGL's gas mix. What is the pricing looking like for not just APM gas, which is regulated, but other sources? And therefore, what can we expect in terms of cost of your feedstock and the final output and the margins? Where are we now on your gas security?
Yeah, I think the gas deallocation happened somewhere in October first time, and November again the second cut was happened. And from 68% CNG, it came down to around 38% the CNG allocation. Actually, we have three segments. So for the domestic PNG, we are getting 100% APM or the domestic gas allocation. For industrial and commercial segment, we are anyway sourcing LNG, which is the imported gas, or the HPHT gas to some extent. And for the CNG segment, we were getting around 68% and it came down to 38%. But in January, it was restored back to 51%. Now, this cost has impacted the procurement cost, and maybe we had around impact of 6 rupees per SCM. So partly we have increased the prices and partly the deallocation has been restored back to the normalcy. So we think now, as of now, our margins will be in the similar range what we have earlier guided, from say 9 to 11 rupees EBITDA per SCM. So I believe the LNG market going forward is going to be more surplus, and therefore we can source more term contracts and do our portfolio management in a way that we pass on some of the cost and we absorb some of the cost to make the impact on the market minimal.
Mr. Shingal, since we are covering the big picture points first, what you're saying is that with this blend, with this mix, you should be able to do margins of about 9 to 11%, right, per SCM. That's what your guidance is.
It's not the percent, it is rupees per EBITDA per SCM.
Rupees per SCM, yes, 9 to 11 rupees per SCM. Now, we are also living in very uncertain times where the US is having an impact on almost everything that we're doing, right? Including, obviously, energy security. And there seems to be a huge push to source more oil and gas from the US. So I don't know if India has to source more US, LNG, does that impact Mahanagar Gas in any way? Are you already thinking about those scenarios and what that does to your blended cost? Because the freight will obviously be more.
No, anyway, we are importing a lot of gas which is related to Henry Hub, which is the US gas. So we don't directly import this LNG. it is through the aggregators like GAIL, BPCL, IOCL, and other players. So we do the tendering, and typically gas comes through the regas terminals, and from pipelines it is come to the company. So
no, absolutely, sir. No, sir, we're aware of that, sir. I was just saying that if these big importers, GAIL, etc., Petronet, I mean, if they have to source more US LNG, will their cost be higher and therefore that higher cost gets passed on to you? I mean, I'm just asking about an outlier scenario. Suddenly, if we have to import far more US LNG.
No, I mean, that is a good scenario for India because Henry Hub is the US index on which the gas is imported to India. And that is a more stable index. So earlier also we have seen that the price volatility in the spot market and the Brent was much higher as compared to the Henry Hub index. Henry Hub index moved from say $3 per MMBTU to $7 per MMBTU in the pre-COVID and COVID times. Whereas the spot gas moved from say $2-3 to $70 per MMBTU. Even the crude moves from $20-30 per barrel to $100 per barrel. So we feel that HH index is very mature because maximum quantity of almost 40% of gas consumption in the whole world is being taken place in US only. And they have started exporting also. Now, so therefore the cost is very stable as far as we can see the situation.
And guess what, Surabhi? What's the one commodity which investors expect? I was reading a survey to most affected by ceasefire in Russia-Ukraine, gas. Lower gas prices.
Because the Russians can start, pumping through.
So that is, and add to that, of course, the fact that I think if you go through most estimates, we will likely have a gas glut in 2025 and beyond for the next few years. So we're looking at lower cost of the stuff, raw material. So thank you for joining us, Prashant here. Let's just talk about something very local here in Mumbai. So the High Court had directed BMC to ensure the shift to gas for commercial establishments, roadside vendors, eateries, restaurants, etc. in a timely manner. Now, BMC has issued some directions to this regard. Could you tell us what could be, I mean, is there an internal estimate? What could be the bump in volume if this were to happen, sir?
See, the commercial establishments are basically big hotels where 100% of the big hotels are being supplied the piped natural gas by MGL. Then there are small restaurants and the eateries are there, and then the bakeries are there. Now, around 4,500 commercial establishments are also getting piped natural gas. The other fuels option for the restaurants is LPG. And for small eateries, it is even wood, and for the bakeries, suppose it is wood and coal. And also LPG, PNG, and electricity ovens are also used for bakeries. Now, there's a mix of all these fuels. As you rightly mentioned, the Mumbai High Court has mentioned that some of these eateries need to move out to the cleaner fuel. So we will be evaluating that how much of they can be accessed. And there is a question of affordability and the licensing and the clearance from the fire department. So all these things plus our access to all these places, because some of these bakeries are situated in a place where PNG cannot reach, because for PNG we need proper safety and other measures which needs to be assured before we supply gas. So that needs fire clearances also. So volume-wise, as of now, around 0.2 MMSCMD is going to commercial establishments, and around 0.5 MMSCMD is going to the industrial establishment. So volume-wise, it is very low, but it will have more impact on the pollution level because wood and coal anyway is very polluting as compared to PNG or LPG or even electricity.
Mr. Singhal, so just to give us a CNG estimate, right? For the 9-month period this year, volume growth has been about 11%. Could you guide us to what could be the full year number? And then for more importantly, 26, what are you expecting?
Yeah, if you see year-on-year growth, last year was whole year 5.5%. In this 9 months, we have clocked a growth of around 12%, and CNG is around 10 to 11%. Now, going forward, the industrial and commercial is growing around 14% or so. So we expect next financial year also to be in double digit, at least 10-11% numbers are expected, because domestic PNG, we were the company, we did the highest numbers in the domestic PNG segment, around 3.3 lakh numbers. And in CNG also, we are adding more infrastructure. Around 50 stations will be added this year and another 50 in the next year. So we think more than 10%, 11% or 12% can be the new number for growth numbers we expect from both CNG, INC, and PNG put together.
So 10 to 11% volume growth, right? And 9 to 11 rupees margins per SCM.
That's right. That's right.
Okay. So very quickly, just 30 seconds left. Just leave us with an outlook on a lot of your EV initiatives. I mean, you've put a fair amount of money to work. You've acquired some entities as well. So when does the revenue and profit start flowing in from those initiatives?
So there is a small investment. We have taken around 31% equity in a three-wheeler electric vehicle manufacturing company in Bangalore. So that company is already starting, revenues are being generated in that company, and it's a startup. So it will scale up after a few years or so. It will take some time. Besides that, we have taken some joint venture position in a battery manufacturing company, cell manufacturing for a battery company. And that we expect will be ready by 1.5 year time. We already have got the land and the civil work has already started. So it will take around 1.5 year time to start the production from the battery manufacturing cells.
Okay. All right. Thank you very much, Mr. Shinghal. This was, very helpful. Thanks for clarifying all of those points, including, of course, the outlook ahead for MGL and what happens in case, even if India has to import far more US LNG, it's good news. It's not a problem. So that's the word coming in from Mahanagar Gas. And the stock's doing rather well this morning. Nigel.
Well, that's right. Let's slip into a short break, though. On the other side, we'll have the management of Maharashtra Seamless, who's waiting for us. Mr. Kaushal Bingani, the Deputy General Manager at the company, is waiting for us. Stay with us. Welcome back. Well, Maharashtra Seamless, that's a stock on our radar. It's corrected close to 40% from the 52-week high. The company reported improved performance in the past quarter. But how are things shaping up? The order book is something that the street is looking forward to. And the promoter entity as well has been buying some shares in the open market. We have with us Mr. Kaushal Bingani, who joins us on the show. Hi, Kaushal. Thanks a lot for joining in. Well, let's get a couple of details first out of the way. We have your total order book, which was roughly around 1,700 crores as of the past month. And normally, quarter four is when you see some increased ordering activity coming in, particularly from the oil and gas space. What is the updated number? And is there any ordering trends you're observing from ONGC and Oil India, which is better margin business?
Good morning, Nigel. Thank you for inviting us. On the order book, it is currently at 1,674 crores right now. There has been no change in the order book because we've been able to replenish whatever we've dispatched with fresh orders. You're right, more orders are expected in the current quarter. And I think towards the end of February or towards the first week of March, we should get some more new orders in, which would be beneficial for the company. And these would be from the oil and gas sector.
Okay, all right. The reason I ask you is because ONGC as well as Oil India as a percentage of your total order book has come down to around 34%, which is much lower than the 50-60% we have seen in the past. Do you want to hint at the total quantum of the orders that you could win towards the end of February as well as beginning of March?
The dip is more on account of a timing mismatch because the lumpiness in order inflow is always there. So in one go, we can get a large order and then there will not be any order for the next few months. That's the way the ordering position normally remains. And I think it is more on account of that rather than the average that we get for the entire year from our oil and gas customers.
Okay, all right. Let's get a couple of details and out of the way, and we'll wait by to hear from you in case there is an order win. What about the guidance on the EBITDA per ton front? I'm looking at the last quarter, the seamless pipes. Well, out there you had a good improvement. It was around 20,000 rupees, while the ERV was around 2,700 rupees, which is a smaller part of your business and continues to struggle. What's the guidance on both these two parameters? And also, what is the volume growth we should work with for both these two segments?
I'll take the volume growth first. In last financial year, we dispatched around 400,000 tons of seamless pipes. This year, in 9 months, we've dispatched 324,000 tons of seamless pipes. And we expect that we will dispatch around 435,000 tons of seamless pipes in the entire financial year. which gives a volume growth of around 7 to 8% on a financial year-on-year basis. Going forward in next financial year, we expect to dispatch around 4.5 lakh tons. The reason why I am giving that figure is because one unit is being revamped. One bottleneck was there, which we are working to resolve. And by December 25, it would be done. So because of the activation of that capacity, we expect an additional 15,000 tons in the last quarter of next financial year, bringing the guidance from 4,35,000 to 4,50,000 for financial year 26. The guidance for the next financial year would be more than that, because once that finishing line installation and commissioning is completed in December 2025, then the entire benefit of the next financial year would be available, and we would be able to dispatch, I think, around 500,000 tons in FY27. That is the growth guidance on the tonnage front. On margins, at the start of this financial year, I'd given a guidance of 15,000 rupees per ton for seamless pipes. Over the 9-month period that has concluded since then, we've achieved 16,500 rupees per ton. And going forward into the end of the year, I think we'll do more than 16,500 rupees per ton on an annual basis.
Okay, all right. So just to get these numbers correct, seamless at the end of this year, 435. At the end of FY26, 4,50,000. And FY27, around 5 lakh tons, correct?
That is correct.
And EBITDA per ton in seamless is 16,500 tons. 16,500 rupees.
Yes, 16,500 rupees for the entire financial year.
Okay, all right. And ERW, you want to quickly give us what you'll do? As of 9 months, you've done around 77,000 tons. How much will you do for the year?
I think ERW will do around 90,000 tons for the entire financial year.
Okay.
And margins are varying between 1,000 to 7,000 rupees per ton, depending on the price of the product which is being dispatched, because prices for oil sector products are different from that in the water sector. So it's more of a function of the product mix rather than anything else.
Okay, all right. Kaushal, I wanted to ask you about this cash in your books. Very good to see cash in your books, which is 30% of the market cap. But what are you all doing with it? Don't you think it would be more prudent to return that money back to the shareholder, give a dividend, do a buyback? I'm looking at the breakup. Most of it is going in mutual funds. And mutual funds, now they're subject to risk, right? I mean, why don't you all just return some of this cash back to the shareholders? What is the thought process?
I like your enthusiasm, Nigel, and we are working on it. So we have quadrupled the dividend which we paid in the past 3 financial years.
But it's still very, very small. But it's still very, very small. It's very, very small, and it's not just my enthusiasm. If I look at your total institutional holding, which was much higher, that's come down, and that's predominantly because of this, sitting on cash and not returning it back to the shareholders. So by when can we hear some kind of a resolution with regard to this cash that you're sitting? Otherwise, it's just a valuation argument, which the shareholders are not getting.
That is correct. And to that effect, the promoter purchasing has also taken place, but that's a separate issue. As of now, we've announced a capital expenditure plan of 850 crores, which is commenced, and bit by bit, we are addressing each of those capital expenditure items. We don't have a dividend policy right now, but we'll just have to wait for the next board meeting in which dividend for the entire financial year would be announced, and we'll take feedback that you've given right now into account.
Okay, all right. And since you spoke about the promoter, he's buying from the open market, so that gives some kind of support. In the last few days, he's bought close to 5.5 lakh shares. And I recall, it's moved up from that 65, 67%. It's now at around 68.5%. Any targeted holding that the promoter wants to have in the company?
So promoter group have expressed their desire to raise up their promoter holding from current levels of 68% to 75%. And to that effect, in the past 6 to 7 years, they've improved the promoter holding, which was earlier at 60% to 68 0.07% as on 31st December. And in current quarter, they've purchased, I believe, around 7,50,000 shares, which is around 0.56 or 0.57% of the total equity capital of the company. And we have received communication from promoters that they want to increase their stake going forward.
Okay, we'll leave it there. We look forward to hearing from you soon again. Thank you very much for joining us. Let's talk about PTC Industries now. That's the next company on our radar. Third quarter was a stable performance. They've successfully commissioned the arc remelting furnace. It's one of the largest here. It's also the first from a private sector company, I'm told. We'll talk about all of this with Sachin Agarwal, Chairman and Managing Director at PTC Industries. Sachin, good morning. Good to have you with us here. Thank you for your time and thank you for waiting. Prashant this side. So commissioning of the furnace was in line with expectations which were out there. And many believe, and I saw this note from ICICI Securities that this will be earnings accretive from FY26 onwards. Could you give us a brief overview of this facility and what kind of revenues are you expecting?
Good morning, Prashant. So thanks for inviting here. This commissioning is amongst the first equipment that is getting commissioned for titanium alloy manufacturing in our new mega facility, which is being built over a 50-acre land. It will be one of the world's largest, if not the world's largest, titanium alloy and products manufacturing capability, fully integrated into a single site. Right from producing from titanium alloys to making titanium products from bars, rods, sheets, plates, all type of raw material products, castings, forgings, the entire value chain, manufacturing supply chain that is required. The first commissioning of the VR is very, very historical. As you said, it's the first time any private company is producing this at this scale in India. We already have order backlog already in place for this. Order bookings have started. There is a big gap in the world in terms of titanium supply chain, especially given all this Ukraine and Russia thing that's happening worldwide, which is created for the global OEM for aerospace, a big challenge for sourcing titanium and titanium products. So this is filling a very big gap in the industry, in not just in India, but also worldwide. There is also a big value addition that we do, right from getting in material from almost 800 rupees a kg to selling products all the way up to 1,50,000 rupees a kg. So almost between 10x to almost up to 100 to 150x increase in value addition. So, and everything in between. So, it is a very, very mega project in that sense.
No, that's very, very interesting to hear, and I would love to chat more about what all this goes into, etc. But we're a little short on time this morning, Sachin. Could you tell us what is the at full capacity utilization? What's the revenues this will generate for you, and margins as well? Yeah.
Okay, sure. So if you coming to the margins first, if you see our previous quarter and the previous financial year, we are at around 30 to 35% EBITDA margin currently. Without this new facility coming in, the revenue for this year, we probably will be around 40% growth than the previous year. The next year, we will be around 100% growth. The potential revenue from this is at least 10 to 20 times our current revenue when it reaches close to full capacity across the entire thing, from titanium materials and superalloy materials to superalloy castings, titanium castings, forgings, and all products that are getting made there. So the total revenue potential for this site or for this company is between 10 to 20x of what it stands in next 5 to 7 years. The EBITDA margins are going to grow even further. We are at around 30-35%. I think it will remain at least at that, or potentially grow to somewhere closer to a 40% EBITDA margin.
So revenues were 250 crores, right? Last year.
Around 270 crores, yeah.
270. You're saying that will grow 40% this year?
Yeah.
And then
30 to
they'll
40%, yeah.
30 to 40%
Double
in
again.
25, and then it'll grow 100% in 26.
Yes.
26.
627.
Yeah. And this from this particular commissioning, you're saying your current revenues can grow 10x, 15x.
10 to 20x, yeah. From this alone, yeah.
Wow. And this is over what period of time?
Between 5 to 7 years. This also includes our acquisition abroad in UK. We have acquired another. So we're completing as I said, I think as you probably need a longer conversation on this, but the entire supply chain is being covered. We have acquired a company in UK called Track Solutions, which machine airfoils for aero engines. This is the technology which is not being provided to the country for a very long time, especially in even the current deal with GE. So it machines airfoils, coating, drilling, all the work that is not being done in India. We have acquired that company. So it gives us a very long run on the entire value chain. And that is the target of the company, to complete all the technological and capability gaps in the country in the metal-related sphere. So yes, between 5 to 7 years, quite a large increase in revenue.
So it could be about, I mean, taking last year's number, it could be in, this alone could be about revenues at full potential could be 2,700 crores more, 3,000 crores from this commissioning.
Yes.
7 years out. More. Okay.
Mr. Agrawal, so that's a 7-year projection from this one facility that you've, this one process that you're just starting. But I want a slight more near-term view. You said next year growth is going to be 40%. Say over the next 3 years, what is the CAGR? Because you're in very exciting segments, and also throw in some more light. I believe that you've done an MOU with the UP government in the new UP defense corridor, and you could be involved in subsystems of parts. So some of the Su-30 components as well. There's a MOU with the Odisha government for aerospace-grade titanium sponge. So these are all very, very exciting sectors to be in. Just tell us, how much are you expecting from the Odisha MOU and which year? How much from the UP MOU and which year? Tying into my overall question, CAGR growth for the company, top line and earnings, profits for a 3-year period. Do you have that projection right now?
So coming to your MOU part, so with the UP government, the MOU was almost a couple of years back. Now there's the plant that I mentioned about in the mega project that's going on in 50 acres is in the UP defense corridor, right in front of the BrahMos facility in Lucknow. So that's already ongoing. So that's where we are having these major investments going on. And I expect all the commissioning and all the execution of the work is going on very well and actually ahead of time. So we'll probably be by end of the next year, all this will be commissioned and in production. So that is where we mentioned about the existing potential for the growth of revenue. The Odisha government, the titanium sponge, we have just signed an MOU. All the financials and everything are getting worked out. All the details of the policy and what incentives we can get from there are being worked out. Just talking about the MOU with UP government, we have got a 25% capital subsidy scheme has also been introduced in the aerospace and defense policy. So there will be a good incentives that will be coming to the company as well through that policy. The CAGR part, what you mentioned, as I mentioned, this year will be around 30 to 40% growth. Next year, about 100%, then probably another 50% to 60% growth after that. So if you're looking at an average, probably a 50% CAGR for the next 3 years. 50 to 60% CAGR for the next 3 years.
50 to 60% CAGR growth next 3 years. Got it. Thank you very much, Mr. Agrawal, for joining in with that conversation and outlook on what you intend to do as well with the business. Well, we are now at 10 o'clock, so it's time to quickly go back to the market and see how we are faring. The indices, I mean, Nifty is still nursing a cut of about 60 points, but the mid-cap index has held on to its green. So let's quickly go across. Shilpa Raut is joining in for some trading ideas. Shilpa, good morning. What are you doing today? Oh, I think we've lost that line with Shilpa. We'll try and get her back. But just to go back to the screen, the cut on a couple of these auto names, it's really showing. Maruti, for instance, is the weakest stock on the Nifty right now. It's down to 2.5% as we speak. And the other problem for the Nifty is HDFC Bank. HDFC Bank is looking at sustained weakness, 2% down there. It's not alone. Even Kotak is weak, ICICI is weak. Basically, Bank Nifty. Yesterday, Bank Nifty was the big star. It was outperforming the Nifty by a mile. Today, it's the other thing. Bank Nifty is keeping a lid on the Nifty's up move. Let's take a break. On that note, we'll come back with the commodity cues of the day in just a bit. Welcome back. As promised, let's head across to Manisha to get a lowdown on the commodity markets. Manisha, good morning once again. So what are you tracking right now at 10 o'clock?
Well, I'm looking at the copper prices, and last week was a great one. And this year has started on a positive note for many of those metal prices, but it doesn't seem to be heading there now, especially for this week. So when you look at the copper prices, it was a 7-month highs in the previous week. We did see a high of 9680, and now currently the prices are trading at around 9350. And the markets do believe that you could be looking at prices declining from here and when. The bigger concern clearly comes in sense of tariffs there. Also, when you look at the US and London prices, the gap is widened to a 10% right now. US is trading at a premium and London at a discount right now. So you're looking at almost $100 of a premium in the US markets. That is how they're commanding it. The US also, in addition to various other tariffs, has proposed auto tariffs to the neighboring number of around 25%. There are duties on semiconductors as well talked about. There also is conversation that US could be putting tariffs on copper as well. A date on that has not been decided. There's a conversation though going, and I've seen a lot of those kind of reports coming in. The markets also have seen the US and Russia conversations. If those proceed better, then you could be looking at Russian copper coming into the markets as well. That's another concern that the area has, and you have seen copper prices come off because of that as well. China ordering restrictions on many copper smelters due to excess capacity has been yet another reason. And then the reason that you saw 2% of a decline come in for copper prices in the overnight markets came in because of a Citi report, which has downgraded their price forecast for 2025 and 26 as well. Earlier, Citi put out a price saying $9,000 a ton is what they're looking at in sense of average prices for 2025. They've cut it down by $500, saying $8,500 is what they're looking at in the next 6 to 12 months there. Also, Citi says that for the year, you could be looking at a small deficit this time around at around 136,000. So this is much lower than where we were in the previous year. So the deficit also has declined. You could be looking at more supplies coming into the market, and that's weighing onto the space. That's exactly what you can see in sense of this chart as well, where we have seen copper prices decline on a week-on-week basis, down by nearly 4%. But on month-on-month basis, we still are up by 7% for copper, up 15% in this year. And the last 12 months has seen copper prices hold those 18% of gains.
All right, Manisha, thank you very much for that. You know, what we're going to do is take a quick commercial break here because our guests are ready. And it's the Indianomics segment. My colleague Lata will be speaking with top experts. We'll have Ajay Srivastava, Chetanaya, and Samiran Chakrabarti on Indianomics, and of course everything which is happening with trade and its implications for an economy like India. Stay with us.